degree from the University of Nebraska-Lincoln. He taught in the econ department at Iowa State, and he has taught at the Graduate School of Banking in Colorado, Southwest Graduate School of Banking, and the Graduate School of Banking in Madison. He has been granted 2 U.S. patents for business processes which unleash value in time deposits. He has also published numerous banking industry articles, and he has served as a director for several banking and financial organizations, as well as Pillar Seminary. Thank you so much, Neil, and I will hand it over to your capable hands.
Well, thank you, Susan. It is a pleasure to be with you and to have this time with all of you in the audience. It is a pleasure to talk with you as I'm looking at the attendees. I recognize several of you who are friends and associates over the years, so great that you've been able to join us here today. We are going to talk about opening the door to early withdrawal. And this topic is an unusual topic, and it's a timely opportunity. Many of you are busy with PPP activity, which is a timely opportunity as well. The urgency of that is certainly understood. This has some similar elements in that we didn't negotiate for this opportunity. It just kind of showed up. And so the question is, will we step up and acknowledge it? And so that's what we're talking about. That's why we wanted to get this in front of you today. And I'm so thankful for our relationship with FHLBank. It is just a great organization. And we'll talk about maybe some of the synergies actually that fit with opening the door to early withdrawal as we go through this today. As was mentioned, I have been a bank CEO. I've been a chief credit officer. I've had a lot of different roles as a bank executive. And when I started in banking in the mid '80s, was the ag crisis, and it was a time of significant change. And what I learned was that nothing in banking seems to happen without a tension, a yin and a yang. And so, the idea that something would just be a windfall is something we all push back on as bankers. We can be jaded. We don't want to be jaded, but it's easy to see how a banker can become jaded because everything seems to have drawbacks. So I'm going to tee this up right now with you all today, and I'm going to ask you to find the drawback in this situation. And so you see that without downside question mark. Welcome you to engage in this topic as we go forward. One of the reasons that there's no downside is that you have complete control over how you approach this. This is not regulated. This is not something that you're going to buy a service from somebody to do. It's an opportunity that exists for you in your portfolio today. And so we're going to show you all of this as we go through our time together here today. So why did this happen? Well, it happened because of the pandemic and the government's response with lowering rates, not in a matter of years, but a matter of just very short period of days, weeks, a month or so. So that is a unique situation where the Fed funds rates dropped dramatically in 2020. And today we have an environment where all financial institutions that take a moment and think about this topic always conclude that their standard early withdrawal penalties that they have had for decades make no sense. Why would I penalize somebody that has a 2% account with us if they want to take the money out early? That's the basic issue that we're going to explore here today. It is irrational that you have a static penalty for a breakage fee on a contract that you might be better off if they break it. Now, you might not always be better off if they break your contracts. That's why you have penalties. But this situation became very unusual in 2020. In addition, although the next things that you have here don't have to occur, they add energy to any bank that is looking to exercise an early withdrawal campaign. One thing that kind of energizes it is, hey, we already have a surplus of funds. I recently was on a peer group website where they said, what are we going to do with this mountain of liquidity? Well, one thing you can do is give back some of the obligations that you don't want to pay high rates on because you already have the surplus of funds. What's contributing to that surplus is the PPP program, which is putting money in the hands of people who are putting it in the bank. And then when it's forgiven, a lot of times that money is not spent. So The financial institution has even more liquidity. And lastly, it is unusual in the fact that in the Great Recession, I remember very vividly when interest rates hit the floor, that many of us thought, well, let's see what happens now because we've never been here before. Maybe rates will pop back up and we will regret letting go of some of the funds that seem to be high rate in a low rate environment. But who knows, if rates pop up aggressively, maybe we'll kick ourselves. Well, that didn't happen. As we all know, it took years for rates to start rising. Here, we don't know whether it'll be years, but we do know most people feel, most bankers feel, that if they give the open door to accounts they have on the books, they will not regret it over the life of those accounts. Now, that said, you do not have to believe all four of these things. You only have to believe the first one in order to think that this early withdrawal campaign is a good idea. So what I'd like to do with you here today is I'd like to have you give me just a little bit of response. Under the participant area, you can see that you have in the web platform, there is an area that is participants, and there's a little feedback. It looks like a microphone. If you click on it, it's going to give you some options. And some of those options are, too fast, too slow, applause. What I'm curious about is on that first thing where the standard early withdrawal penalties seem to not make sense. If you believe that, just click on the yes. Or if you're not so sure, you can click on no. So I'm going to click on yes and see how many other people are understanding this issue in the same way that I am. So I'm looking for the feedback from you, and I appreciate honesty. If it doesn't connect with you, I respect that too. But it's great to see we've got some people going, yeah, I get the whole early withdrawal penalty. Why would we penalize somebody for doing something that's actually good for us? So thank you for that, those responses. It's very helpful for me. So the question then is, how did we get here in terms of operationally, and what would we do about this? So I will tell you that if you would have asked me about this, I'm presenting to you, but if you would have asked me about this 12 months ago, I just said, I have no clue what you're talking about. Early withdrawal campaign? Never heard of it before. But today, our clients, as we look back, there was a time last summer when we have about 50 clients across the country that send us their reports every month, so we can see the accounts they have on the books. And I was going through these reports, and this account stood out not because it was outstanding. It stood out because it was kind of middle of the road. It wasn't particularly large. It wasn't particularly small. It wasn't particularly long. It wasn't particularly short. And it was representative of what 2018 and 2019 created at 208. A $60,000 deal that matured in November of 2022 at a 208 rate. The interesting thing is when all of us with the mathematics background start marking it to market, and we find that there's $2,000 of value embedded in it that's above market rates. Because if I went out to FHLBank and replaced that funding, I could get it much less than 208, be no negotiation. I know exactly what I'm going to pay for it. Why don't we see what would happen if we offered the retail depositor an opportunity to exit? And what if we, and please don't think this is precise, it looks very precise, what if we offered them $873? It's basically pulling out a number somewhere between zero and the value of that mark-to-market adjustment, and I just picked $873. So this was last summer, summer of 2020. Never done this before, never seen it before. And I said, I wonder what would happen if we went to the financial institution that has this account and said, have you thought about offering the depositor an incentive to withdraw early? And of course, the answer was they hadn't. But now today, we can tell you that over months of doing this, some of the experiences that we've had. And that's really what this session is all about. So let's get into it. Let's run some numbers so that you are seeing this opportunity and could apply it to your situation. Now, This is not typical of every account because 3% is pretty high, but I'm going to show you how we run the numbers. We take the current interest rate on that account. This is a real deal that's out in the books of a financial institution. 313, the current balance is 157,000. Pretty significant account. It doesn't mature until March of 24. So that original account was a 5-year account. It still has 37 months on it. So the key factors, the rate of the account, the length of the account, and the size of the account. Those determine this differential between today's rate and what it was booked at. So we run the numbers, and if it goes to maturity, that financial institution is going to pay out $172,806. This is just math, folks. This isn't any art to it. It's just math. And then if we said, what if we went to the Federal Home Loan Bank and replaced it for 37 months? At the time I ran these numbers, that was 61 basis points. Simple adjustment, simple refi. So we pay out the depositor, we refinance at 61 basis points, and instead of paying 172,000 at maturity, we pay 160,000 as the financial institution. We just saved the financial institution $12,654. That's a pretty significant number on $157,000 of funding. So that would be the case if the depositor just wandered in and said, hey, can I get my money back? Well, we would have to tell them that we're going to waive the penalty. Oh yeah, we'd be happy to waive the penalty. But what if, but first of all, are they even going to suggest that? No, we spent years telling them, and we can hear the radio commercials in our head for those that are older, substantial penalty for early withdrawal. We have, as an industry, communicated substantial penalties. So most people don't even ask what the penalty is because they hear it's really bad. So why would they want to redeem their account early? They don't. They're not going to. They're only going to do it if you invite them, if you open the door, and you give them an incentive. What if we gave them an incentive of $6,116? Now here's where we're into the art. There's not one way to do this. There's no prescribed way to do this. There's no wrong way to do this. But we picked a process, an algorithm, and we offered $6,116, which means that we're going to pay out not $157,000 today, but they could cash out today for $163,000. It's like taking a gain on the sale of a bond. Exactly. So if they did that, and then we replaced it with FHLB at 61 basis points, then we would pay out $166,000 at maturity on the same date as their current retail deposit, March 13th, 2024. We would pay out $166,000, which means we just saved our financial institution $6,400. So as a benefit compared to the size of the funding, it was a 4% profit. It had a profit margin of almost 4%, 3.93%. So for everybody on the call today, for all of you, that is the crux of the issue. That your financial institution is sitting on a portfolio that has some of these accounts in it, that if you open the door, some of them will choose to leave. Now, every one of you is sitting there going, but why would they? Well, stop thinking like a banker for a moment, because if everyone approached things with your paradigm, there would be no lottery tickets purchased. There would be no credit cards revolving at 19%. There would be no, wasting of financial resources. But not everybody does a discounted cash flow analysis. And we can open the door and allow them to get money, their money, sooner rather than later. And they will do it. And if we look at this not on just the basis of one account, but we start looking at the portfolio, this is about a $150 million portfolio. And in that $150 million portfolio, there's $71 million, a little less than half for this particular financial institution that would qualify for a thank you incentive. Like, keep in mind I said thank you, because we got a contact opportunity where we're going to reach out to a depositor and thank them for doing business with us. We're going to express how we're financially very strong here, and we can certainly accommodate the agility of letting them have their money sooner rather than later if they would like. That would be 681 invitations for this particular financial institution, and if everyone took it, the financial institution would have a windfall of $564,000. Now, of course, moderate our thinking. We will never get a majority of people to take it, but it doesn't matter, because every one of those 681 invitations is a thank you, a letter of respect that we really thank you for doing business and we appreciate the opportunity to serve. And by the way, within a window of time here, you can have access to your money if you'd like, along with a substantial gain. And when you do, some of these numbers will accrue to your equity. You will make more money by opening the door to this withdrawal. So I've talked a lot about the math. And most of you are saying to yourself, okay, if I get the math, what else do I need to know? What else is there? So data analytics, we've talked about. Pricing the option, there's some art to that. We'll say it this way. It's kind of like taxes. If you set a tax rate that's super high, you might not collect much tax because nobody does anything. So if you're going to set a super low rate for the incentive, you might not get a lot of offers taken. But if you set a super high incentive, you won't be able to keep much of the benefit. So there's sort of a Goldilocks thing that happens here. You want it to be an incentive that's worthy and worthwhile based on their situation, but not so big that you give away all the value. Formatting the offer is a big deal, and I'll kind of conclude the webinar with specifics about formatting the offer, because it's your touch to that depositor, and very important that they feel good about your institution as you're opening the door. The other people that we have to think about, that you want to feel good about this, is your front line. Your member service rep and your customer service rep who's working with that depositor worked hard to get them to take those accounts in many cases. They don't like the idea of giving them back. So we prepare a frequently asked question, and this is essential that you anticipate some of those conversations. And when you do, your learning curve is very short, and everybody gets on board and feels good that you're an outstanding organization that gives your depositors more choices than your competitors. We go above and beyond the terms and conditions in our offerings. Then we designate and prepare a team. So not everyone who sells accounts is in this squad. This team is a hand-selected team of people who are going to prepare and deliver offers and handle the responses. Depending upon the size of the financial institution, it can be a very small group of people who get on board with this and love the idea that they're going to enhance financial performance and bless these depositors with their opportunity to get their money back sooner. Then they deliver those offers. Essentially, it's a mail merge opportunity where you take that data and you put it into a formatted letter. Send that letter out and then handle the responses that come back in. So these are the elements that we talk about. Now, here are some of the things to shorten your learning curve that you will encounter. These are things that back in the summer when I identified that one account, I didn't think through. I didn't know anything about what would qualify, what wouldn't qualify, how people would react, how they would feel. But now that we've been doing this for months, we're here to tell you, you're going to exclude your broker because you don't have access to them, that you don't know who they are. Brokered accounts don't qualify. You're going to exclude IRAs because you don't want to put them in play, because to withdraw from your current account, they need to be back in an IRA someplace, and it's just too messy with the tax issues. You definitely don't want to open the door for deposit accounts held as collateral because you're holding them for that purpose. So we don't qualify them. How do you handle partial withdrawals? Very important that you open the door and you pro rata your incentive for them. If they want to do part of it rather than all of it, that's a wonderful thing. Every dollar that they redeem early is going to benefit your organization. And then other things on this list that I'd be happy to go through. But I'm mostly trying to make sure that everybody's feeling energized by this and seeing this. So I'm going to kind of stop here, Susan, and just see if there are any questions that have come up. I'm going to go back through this entire list, but before I try to wrap that all up, I'm going to just see if there are any questions that have arisen from the audience in terms of the Q&A or chat that you have observed. I'm surprising Susan, so she may be disposed in other ways at this point. But if anyone has a question, just post it out to me, and I'd be happy to address that. So there you are.
Sorry about that, Neil. Sorry.
No problem.
Step away for 1 second.
Not a problem. Sorry about my poor timing.
No.
Have you seen any questions that have come in?
I have not seen any yet.
Okay,
so.
I'll just keep moving then with these issues that oftentimes thinking about the details of your financial institution, having worked at growing these accounts, and you'll notice also when I was introduced that the whole point of my company is help to grow properly priced deposits. Well, this doesn't seem like it fits. We're not growing properly priced deposits, but we are purging non-properly priced deposits. And the beauty of that is when you get rid of those uber expensive accounts, you have room for properly priced deposits. And that's a big part of getting rid of the pushback, because if funds are going back to depositors and they're happy, they're going to be thinking you're the financial institution that they should do their next accounts with. You're not the bad guys in the story. You're the good guys. You're the people who care and make a difference. So let's look at some of these other topics as Susan's looking for any of your Q&A. Let's look at allowing funds to flow out of or back into other bank accounts. This is very important that you don't put strings on these account withdrawals. In other words, when you send somebody an invitation to withdraw their money, it's that simple. You are allowing them to withdraw the money. There is never to be, if you're going to work with us, there's never to be a string attached to it. And why? Because it either is an opportunity to redeem or not. It can't be redeem as long as you put it in a savings account here. Nope. If that's how you think about it, don't do it. It's not worth the effort. But if you simply allow them to redeem it, you'll be very pleased at how they handle their results. You just can't put any parameters around it. How about handling inquiries from depositors that push back on the price? Say we offer $6,100 on that account, and they say, I won't do it for $6,100, but if you make it $8,300, I'll do it. Terrible idea. If you're going to do an early withdrawal campaign, set your price, set your expiration date, and let it be. They either take it or they don't. They either want the money or they don't. This is not a negotiation. That's how you stay out of trouble. That's how you make sure this is only good things happening from it. What about account holders who come in and they find out about this? They heard that their friend got an opportunity to cash out early. They didn't get an opportunity. It's very simple and very clear, because any account that was booked before March 11th, if you exercise this program, we highly recommend you waive the early withdrawal penalty on all accounts booked before March 11th, 2020. So you have good news for every account holder who comes in and says, hey, I understand my buddy got an incentive. Where's mine? Oh, well, maybe you didn't qualify to get paid, but I want you to know if you do want your money back, you too qualify for an early withdrawal waiver. We can do that for you. Would you like your money back today? I guarantee you that you have accounts on the books that were booked before March 11th, 2020. You will be able to reprice those more cheaply today because of what happened in the interest rate environment. So everyone wins. You're not picking winners and losers. Your written and verbal communications have to be clearly defined. You want written communication for a product that your audience might be skeptical. They've never seen this before. You've never done it before. Your competition has never done it before. So you want to provide them written evidence of your offer and then have verbal communications that synchronize with that written communication. That's why you want this to be a small team of people who exercise this campaign. Disparate treatment and impact of protected classes is a non-issue because you're using an algorithm consistently to set the price based upon three things that have nothing to do with protected classes: the size of the account, the length of the account, and the interest rate. So we stay away from any UDAP issues. UDAP is all about protecting your account holders from abuse, from deception or abuse. They don't need to be protected from getting their own money back early. There's nothing negative about that. Handling the exception of the option. The option should not be set to expire too quickly. In other words, if I'm a consumer, say I'm a 73-year-old who has a long-term deposit at your financial institution, what I don't want is to get an opportunity that is a short-dated, I have to decide by tomorrow afternoon. Not a good idea. Give them a window of time that's long enough that they feel comfortable making a choice, actively making a selection of, yes, I'll take it, or no, I won't. Either way, here at our financial institution, we're just happy to make the offer. If you're a larger financial institution, we have some larger ones on the call today. If you're a larger one, you might want to do it in blocks. Rather than sending out a lot of offers at one time, you might want to send out a group and then handle that, process that, and use that experience then to send out another wave or flight of offers. I will wrap up this particular slide with the idea that yes, you will be paying an incentive, which you have to book as an interest expense, and the depositor will get that on their 1099. It's interest that supplements the ongoing interest that you're paying them. But it terminates the account, and on the day paid, it will go on their 1099 for that year. We had a number of clients who wanted to get this done in 2020 because they knew that 2020 was going to be a good financial year and they wanted to enhance future years. It's a great product to do that. But now that we're in February of 2021 and you're going to exercise this program, you're going to see that it's going to be an interest expense in 21, and it's going to reduce your interest expense in the remaining months of that account's life by much more than the interest that you're going to pay in terms of a campaign issued today. So those are a number of different topics that we have had. Some people have asked about the extend and blend that you can do when you are managing wholesale funding. It doesn't apply in my experience to this retail funding because you're not actually extending it with another retail client, comparable client. So although I'm not an expert in blend and extend or extend and blend, we do not believe it qualifies. So I wanted to make that point to this audience. So with that, I'm going to emphasize the invitation because the ability, this is what our original experience was. Hey, I'm not sure we want to send these invitations to our best clients, our clients that we would not want to ever lose. And so some of our clients originally chose to send it only to single product clients. You know, they have a CD and that's all they have with us. But they ended up kind of transitioning to, why wouldn't we send this to our most valued relationships? Because we're telling them how exceptionally strong we are. We're telling them that we really value doing business with them. And times have changed since they booked this particular account. When we have the ability and skill to go above and beyond the terms that we negotiated for back when you opened the account. And by the way, there's no obligation on your part. There's no strings. We are perfectly happy if you do nothing whatsoever other than accept our appreciation. But if you would like, we would pay you a bonus if you want to withdraw the money now. No pressure. They get weeks to decide. Thank you for doing business with us. And over time, realize that most of our clients that decide to go forward with this don't segregate out their best clients. They send this to everyone, and they get positive feedback from everyone that they send it to. So here's a situation. We used Rate Watch and we pulled data, and this may or may not represent you, but what we know for sure is that rates have gone down over the time from December or anything before the pandemic date of March of 2020. Anything before that, when the Fed rates were higher, would be something that would be a good candidate for early redemption. As your rates might not look like this exactly, but we're pretty sure of the trend. And if you have some of these on the books, running the analysis that is really a fair value or mark-to-market analysis is how you get to the position of knowing who's really eligible and how much of an impact this might make. So we've done that with all of our clients. We've taken that client data and looked at it, and we have found that in many cases, the numbers aggregate very nicely. I've highlighted for you here a particular financial institution outside of the FHLB Topeka, and it's a $1.2 billion organization. Their interest rates are 204 on their yield in the third quarter. They have 434 million of time deposits, and they had 181 million of CDs that had a maturity date between 1 and 3 years, and 14 million that were over 3 years. 196 million at the time of the pandemic were booked for more than a year. That means they're still on the books most likely today. And we can roughly estimate that they have $2.5 million of what we call raw early withdrawal potential. We'll never see all that be taken advantage of, but it's pretty easy for us to predict what at 5% take rate, which we consider to be a bare minimum, that they would have $123,000 of windfall. At a 25% take rate, they'd make about $600,000. So we can run these numbers raw based upon call report data, but then we want to always be able to validate them when we look specifically at the accounts that are actually on the books, which can have a degree of difference from these aggregated numbers on the call report. So I thought that would be, Susan, kind of interesting for the audience to look at some of these numbers of financial institutions. You can see that there are some that have very low cost of funds and some that have a very high cost of CDs still as of the third quarter. So it's based upon what they were selling and what the activity was as they went through. Here's a particular financial institution that we look back in September of 2019. We see that they were pretty much on the median. Their peer group, they were at 207 in the peer group, and their particular cost of CDs was 212. They were right there in the kind of the middle of the pack. But over time, their peer group has lowered their cost into September to be at 149. Meanwhile, they're now in the 88th percentile. Their cost is rising. We know that they have not been offering high rate CDs. They're just dealing with the baggage of having those on the books, and they haven't been able to get rid of them. This helps them. This opens that door to the movement outside of the portfolio. So Susan, I'm looking to see if we have any other questions or comments that might have come up from the audience.
Neil, I do not see any yet, so might give people a moment to think here and absorb the information. I have a question for you, though.
Okay.
While we're waiting.
Sure.
So, how does this impact the interest rate risk of the bank?
That is a really, really important question because you all are managing a portfolio of funds that have come in to fund your assets, loans and deposits. And if you want to keep the duration, so let's do this. Let me pull up a sample bank here. So if if we have some funds that are at 37, 32, 34 months left on them, and they redeem early, you really have a choice, and from an interest rate risk perspective, that you can replace them with those comparable terms using FHLB advances or other wholesale funding sources. You can replace them and not change your interest rate risk at all. You went from one term obligation to another one and made money in the process. Some of our clients, Susan, are saying, we actually have so much liquidity that we don't really need to do that. We'll monitor that, but we're going to replace it. We're not going to replace the funding. We're just going to lower our cash position. We're going to let that, instead of going to our securities manager and saying, you need to buy some bonds. Well, that's not very pleasant in this environment. Let's reduce the pressure on the fixed investment portfolio purchases. And yes, that does change the interest rate risk, because instead of having these 30-some month fundings, we just reduced our cash position. So you would always go back to your ALCO and look at it holistically. But there is no intrinsic reason that you have to change your interest rate risk. In other words, you can just say, hey, we just had a $160,000 deal mature. Let's go fund an exact comparable amount at the new rate with the wholesale funding. It's really up to the financial institution. Great question, Susan. Thank you for that.
Sure. I'm not seeing any other questions right now, but I do have one more for you.
Okay. Okay.
How many of the offers, I know you talk about, selecting who you send it to, but how many do you send at one time? Like, is there a, volume that you should do so you can keep up with it, or?
Usually what happens is that the initial entry into sending out the invitations, you're working on the mail merge, you're trying to get your team ready. So that batch is sometimes smaller. Here we have the data for a particular portfolio. There would be 496 invitations sent for this particular portfolio of 152 million. Now that can vary. It's not a precise ratio or anything like that, but if they wanted to send them in batches, I'd probably think they might send out like between 100 and 150 in the first batch, and then kind of get their bearings as to how that's working, and then send the rest in one more batch. We would recommend if you have more than 1,000 invitations that you definitely batch them, but you might just send all 496 if you so desired. The other thing you can do is run a pivot table and say, okay, I want to take these, some of these important ones, but maybe not the biggest ones, and I'm going to do this batch of 23 and 12, which has an opportunity of $52,000. I'm just going to do those, and then I'll worry about the biggest ones in terms of impact. This group, maybe I'll do them later, or maybe I'll do the ones that have even less impact later. But it just kind of depends on how excited and enthusiastic and confident the team is. If you're excited and confident and you're ready to roll, you can send all 496.
That's interesting. I like this prioritization approach, because you could kind of pick the ones that give the biggest bang for your buck first.
Well, that's absolutely the case. Yeah, when I said this is one of the things that it's so good at the beginning is it's completely discretionary. In other words, I've had people say, you know what, I might just send this one. I might just send the offer to this one, and if they take it, I just made $6,400. There's no downside. They either take it or they don't. And if I don't send it, we know they're not going to take it. If I do send it, I just made the bank money. And once that mentality gets involved, then the people are going, well, why wouldn't we do the rest of them? And so, of course, from our standpoint, there's nothing that anyone needs to buy from us. There's nothing you have to do other than just make sure. My point in holding these presentations is I want to help the industry do well, that we should do this because it's benefiting our clients. And you don't have to buy anything from anybody to run one of these campaigns. So we're very honored that this audience has chosen to get involved. But my guess is, if you're seriously considering doing this, that some of those ideas that I popped up They're about issues. Let me do it this way. We highly recommend that you create a frequently asked questions, not for your depositors, because for the depositor, the invitation is really clear. They don't have many questions other than, I guess I can do this or I don't have to, right? But with your people, that's where you have the questions. Your team are going to ask questions like this. They're going to say, well, who's supposed to be handling this? Who receives these offers? Is every one of my depositor going to call me about this? How did we determine the size of the incentive? How did we route all of this why did we route it to one area of the bank? Your team on the ground, working with those depositors, they're going to need to know these things. And this is what we typically help our clients get in touch with this list. And this is where I'm guessing that some of our audience is going to have a question about, well, how do you deal with, how long you honor the request? You can see that's a topic on this. So more than happy to engage here in the remaining time that we have for anyone who wants to do this. And if there's somebody who thinks it's a bad idea, we love to hear any of your anxieties or pushback, because the reality is, I told you early, as a banker, I know that you have this emotion about, if I've never seen it, never done it before, it's got to be dangerous. There's no danger here, folks. And if you think it's dangerous, I'd love to hear what it is. I've told somebody I'd pay you $100 if you can tell me of somebody who's tried this and had a bad experience. And to date, Susan, I haven't had anybody ask for their $100. So I'm not trying to be cocky about it. I'm just trying to say it's safe as long as you've really worked the process. But in banking, what's not that way? We have people who say, I don't want to get involved in PPP. Well, I'm sorry, but that PPP program is a really good idea. If you want to opt out, you can. I just don't see how you're serving your client base. So I'm not here trying to lecture anybody about PPP, but it's been so good for our clients that have done it, and they've blessed their marketplace in that process. And we're just hoping that we can do that for your clients here today, Susan.
All right. Well, let's see. I do not see any questions at this point. So I would say go ahead.
I see one pop here.
Yep, too.
There we go. Trying to get it so I can read it well.
There we go. Yep.
From an accounting standpoint, are our incentives booked at the time of payout? And the answer to that is absolutely. So as you are redeeming the account and closing the account, right, you book the interest, you accrue and book the interest on that account, and then you make sure it gets on their 1099. It's reportable income to them. So will examiners question a huge increase in interest expense? To date, we don't have anyone, as interest rates are falling, where it's become such an anomaly. In other words, no one that we know of is paying millions of dollars in these extra interest expense that creates such a mathematical anomaly. But if examiners ever ask you about this, you can lay out the program, what you did and how you did it, and we're quite assured that you benefiting your clients and benefiting your bank is something regulators will approve as long as you do it consistently. And that's why we don't negotiate. So if you ever have your buddy who says, I'll do it, but I'll only do it at this price, avoid that temptation. When I say your buddy who is a depositor. We don't play favorites in that process. So that's the only counsel I'll give you about examinations that, where it gets a little edgy or dicey would be playing favorites and then having to explain why you did something different. To be clear, because every account will have a different size, duration, and interest rate, the numbers will always be different. In fact, we have had people say, well, why don't we just offer everyone who qualifies $200? That is a terrible idea, because if you offer everyone who has a high rate CD $200, you are playing favorites, because you're not setting up a fairness to the financial institution and the depositor, because some qualify for a much bigger incentive, some for lesser. Trying to simplify it with the same number, a nice round number for everybody, is a bad idea. Thank you for the question. I'm looking to see if there are others. That's all I saw.
That's all I saw too. Look and see in the chat area and make sure there wasn't anything there either. So I think that might be all the questions we have. And Neil, I think you have a slide with your contact info on it. Is that right?
I will pop that up.
So I know if you're like me, it has to sink in a little bit sometimes, and you're working through something else, and questions come up. So if that happens, please reach out to Neil. If you lose his contact information, you can reach out to us, and we'll be happy to give it to you. And I'm sure he'll be happy to answer whatever questions you have. And we do have one more question about the slides, if we'll make the slides available. And yes, we will do that later this week. So we'll send the slides out to everybody that attended the webinar. So
wonderful. Susan, I'll just end with this comment. So sometimes people ask me, well, what's in it for you? You're spending all this time, all this energy. Well, we have clients who have benefited from this, and so we are benefiting as they benefit. And our basic business, Susan, is that we help financial institutions use new tools and new approaches to the old-fashioned CD. And there's new things coming that we haven't unveiled publicly, but new approaches to how to open the door to an enhanced withdrawal opportunity. This is not an ongoing, recurring thing, but you're going to find down the road that CDs will be modernized. The old 6-month penalty will not be a thing in the future. If you're sitting there with a static penalty, know that you're going to see your competitors change that. And then the other thing I'll point out is look for BAI banking strategies. If you're a subscriber of that, that's great. But look for that on February 18th. We have an article about the topic that you just saw. We've waited until now to publish it, but that's going to be coming out, we're told, according to the editor, February 18th. We hope that this benefits you and your deposit base, and we hope that you think about us anytime you're looking for opportunities to better engage your team so that they better engage your depositors. Thank you so much for this opportunity.
Excellent. Thank you, Neil. We appreciate you presenting this idea today. Hopefully it's something that people feel like they can use to lower their cost of funds and get some of that liquidity off their books. So once again, if you have any questions for Neil, just give him a holler and he'll help you with that. And I would like to ask everyone, if you would fill out the survey that will come up when you log off the webinar. It may come up in a separate window, but we appreciate any feedback you'll give us on our webinars. And with that, I think we'll be done today. Thank you everyone again for coming.